This is the hold report for Thursday, January 8, 2026. The Civil War Chest. The S&P 500 is currently fighting a war with itself, paralyzed between the crash in global tech and the boom in national security. The market closed flat on Thursday, masking a violent rotation in capital allocation that signals a shift in the market's perception of the new administration's priorities. Donald Trump called for a $1.5 trillion military budget for 2027. The announcement acted as a starter pistol for the defense sector, driving iShares Aerospace and Defense, ITA, to fresh highs. Counterbalancing this surge was a sharp pullback in megacap technology. Nvidia and the broader semiconductor index slid on reports of tightening export friction with China and rising bond yields. The market is splitting. Traders are selling global growth, tech dependent on open supply chains, and buying national security, defense dependent on state spending. The flat index is a result of these two massive tectonic plates grinding against each other. The White House's $1.5 trillion spending target comes with significant strings attached. Administration officials signaled a crackdown on buybacks and dividends for contractors who missed delivery targets. This effectively treats defense primes less like private enterprises and more like regulated utilities with guaranteed revenue but capped sovereignty. Despite the governance threat, the sheer volume of capital promised was enough to trigger a broad buy signal across the sector. Meanwhile, with no governance, AI still struggles to make money. In September, OpenAI introduced a feature allowing users to make purchases directly within ChatGPT, promising access to millions of merchants. But the rollout has been sluggish. The delay stems from the complex work required to standardize product data and integrate payment systems. The market is noticing and beginning to demand execution over infrastructure spend. OpenAI's Sam Altman promised rough vibes, and he is delivering them. As the digital economy hits friction, the physical economy consolidates. Glencore and Rio Tinto have reportedly resumed talks on a potential $260 billion merger. S&P Global warned today that a severe copper shortage poses a systemic risk to the global economy. The market is pricing in that the energy transition and the AI boom are competing for the same finite physical resources. Bond yields ticked higher, exerting pressure on long-duration growth stocks. Weekly jobless claims edged higher, but productivity jumped, creating a no-collapse, no-rescue environment. With the economy resilient and fiscal spending on defense ramping up, the bond market is removing bets on aggressive rate cuts, keeping the cost of capital high for the tech sector. Oil markets remained volatile as the administration's resource seizure strategy became explicit. The Trump administration reportedly ordered U.S. oil majors to re-enter Venezuela with the directive, "Do it for our country." It's a heavy ask. With the Russian shadow fleet still maneuvering in the Atlantic, the risk premium on Venezuelan barrels remains elevated despite the seizure narrative. On the ground, protests have erupted in Minneapolis following the fatal shooting of a civilian, Renee Good, by ICE agents yesterday. While currently localized, the hardening of federal rhetoric suggests a confrontation that could disrupt regional stability. Federal law enforcement agencies are blocking state-level investigations, creating a constitutional friction point. Thursday's tape tells a clear story. The geopolitical risk premium has arrived. It is boosting assets that benefit from conflict, defense, energy, copper, and discounting assets that rely on global cooperation, tech, semiconductors. The disconnect between equities and fixed income has rarely been wider. The stock market is treating the potential defense budget as stimulus. The bond market is treating it as a warning. History suggests listening to the bonds.